Ashchand and Company, one of India's largest education books publishers, their quarter one fiscal year 2026 figures are out. The earnings have been out for quite some time. So let's check out these earnings and see what actually happened. So first we have the consolidated annual performance. Now these figures are a bit small, so I apologize. What we want to see are the figures for quarter one fiscal year 2026 compared to quarter one fiscal year 2025, and both of them are to my right. Yes, to my right. So first we have revenue from operations. All these numbers are millions of rupees. Revenue from operations declined 7% year on year from 1107 million rupees, that is 1000, that is 110 crore rupees, to 102 crore rupees. So from 1107 million rupees to 1026 million rupees, so revenue from operations declined by 7%. Then here we can see the gross margin has declined from 72% to 67%. Then we see the EBITDA. EBITDA declined from a positive from a positive 84 million rupees to minus 91 million rupees. So went from positive to negative. EBITDA margin went from 8% 12 months back to this quarter minus 9%. Here we see profit and loss. Let's see here profit and loss for the period below me. So profit and loss was minus 30 million rupees for around, this was fiscal year 2025, the first quarter. But for quarter one fiscal year 2026, loss has expanded to minus 141 million rupees. So revenues have declined, profits have declined even further. So what's the reason? The company says there's nothing to be concerned about. Okay, they say that the year-on-year decline in quarter one revenues is due to shift in the content licensing, that is AI datasets revenues, from quarter one to quarter two. We built the content licensing revenues of rupees 30 million during quarter one fiscal 2026 versus 115 million in quarter one fiscal year 2025. This gap of roughly 85 million rupees largely flowed through the P&L, leading to decline in EBITDA and profitability during the quarter. And we expect the content licensing slash AI datasets revenues to be recuperated in quarter two. So the company is saying that this decline in profitability and revenue, there's nothing to be concerned about. It's just a timing issue. Here they say that there was a shift in the content licensing business. Content licensing business. What does it mean? Basically, Ashton is a publisher of books, right? So they have a lot of educational content on their hands. And what happens is that there are companies with AI models or machine learning models, they will need some data to train. In order to learn, they need some data. So Ashchand, with its educational books, can provide them that educational content. They can license that content to these companies for a fee. So this is the content licensing revenues. Now, unlike their book business, which is seasonal, this is not a seasonal source of revenue. So there was some timing issue. So whatever revenue was supposed to come in this quarter from AI content, sorry, from content licensing, will now come in quarter two. So quarter two figures should be better, should be better maybe. And decline in profitability was because of this. 11.5 crores came from this content licensing in quarter one fiscal year 2025, that is 12 months back. And this quarter only 3 crores came in. And this 8.5 crores gap will now be recuperated, fully recuperated in quarter two. So that was the reason for decline in profitability. But these are not the only results we are going to be looking at, because Ashton's focus, when we want to see focus on financials, is more than just the profit and loss statement. Therefore, we move to working capital management. Very, very, very important for Ashchand. The working capital is current assets minus current liabilities. All right, money used to actually operate the business. Now here we're talking about receivable days. Receivable days are days, how many days it takes for you to get your money back from customers. right? Because you give your goods to customers on credit. Okay, you don't take money from them upfront. In many businesses, you give the products to customers and they pay you back after some time. So receivable days have declined continuously. In quarter one fiscal 2026, the 89 days declined from 92 days in quarter one fiscal 2025. The lower this figure, receivable days, the lower it is, the more efficient the company is, because it means it's taking less time for you to collect the money back from your customers. So receivable days have declined from 92 to 89 days, and net working capital days has declined from 132 to 119 days. Now, what is that? Net working capital, current assets minus current liabilities. So the net current assets that you have, okay, how long does it take for you to convert that into revenues? Basically, if you did not understand that, this is a basic efficiency metric. The lower this metric, the more efficient the company is and the better its cash flows will be. Okay, real cash flows. So it declined from 132 to 119 days. Here it says improved working capital efficiency has translated into strong cash flows, leading to continued net debt free status at the end of quarter one fiscal 2026. This net debt free status we will come to in just a moment. And receivable days are below 90 for the first time ever in the company's history. In the company's history, first time receivable days have been below 90. So that's great. Then net debt free with controlled inventory. All right. Now, what is this net debt free? Net debt is basically total debt minus the cash and cash equivalents or assets which can be easily converted into cash of the company. So, when you see this negative figure, right, these negative lines, these bars going negative, which means the company now has more cash and cash equivalents than it has debt, way more cash than debt. Here you can see all these numbers are in millions rupees. I believe this should translate to 116 crores of cash and cash equivalents more than debt. Not just cash and cash equivalents. 116 crores of cash and cash equivalents over debt. Excess of cash and cash equivalents over debt. So debt there continues to be net debt free. Then inventory is being managed better for the last, let's say, 2 years, from 2023 all the way to 2025. You can see the inventory is down. Finished goods inventory is at approx same level since June 2023. Total inventory has 279 million rupees of raw material paper versus 485 million in quarter one fiscal 2025. So raw material, the paper inventory has declined, and finished goods inventory is almost at the same thing. And these are important. This figure is important because higher your inventory, worse will be your cash flows. Okay. More your inventory, more is the increase in inventory, worse will be your cash flows because cash gets tied up in inventory basically. And what this led to is this. Focus on this figure. Net cash generated from operating activities or cash flow from operations increased from 353 million rupees in quarter one fiscal year 2025 to 412 million rupees in quarter one fiscal year 2026. So now this quarter's cash flow from operations were actually 41 crores. So this much was real cash actually made in this quarter. 41 crores from operating activities, from its operations. 41 crores of cash generated from its operations. This is a massive increase from last quarter's 35 crores. And even though profits declined, this increased. Why? Because of better working capital management. All right, way better working capital management. All right. So I think these were the figures. Now, moving on, we see the company's updates for this quarter. All right. Now they first talk about the integrated plant and warehouse facility. They have a new warehousing facility which is now fully functional. Okay. Their integrated press project. They're making an integrated press. It's going to be completed over the next 12 months. So these two things, the integrated plant and warehouse facility, should provide some benefits for the group, like improving the efficiency during the peak season, okay, implementation of best practices for warehousing, including warehouse management solutions and automation, all right, and improve efficiency in loading and unloading, faster TAT time for order processing. Okay, more efficient, basically, more efficient, more time saving, and more cost savings for the company. Now, this is important. Looking for mergers and acquisitions to fill gaps in our product offerings over the next 2 years. So the company is looking for mergers and acquisitions. We're actively looking at making selective acquisitions in our group over the course of next 2 years. All right. Acquisitions targets are to be selected based on the ability of the target company to fulfill the gaps in our product portfolio. And this would be driven by factors like penetration in new markets, new product offerings, and acquiring new technologies. So they want to acquire a new company such that not only will it help them going into new markets, have new products, but it should also fill a gap in the existing products. This was a new manufacturing facility, some of the photos. And finally, guidance for fiscal year 2026. The main thing here, they expect the revenues to cross 8,000 million. So this year, they expect it to cross 800 crores. That's the revenue. They're upgrading the EBITDA margin. Okay. The guidance was, okay, last year was 17 to 19% EBITDA, right? Guidance. This year, they're upgrading it to 18 to 20% EBITDA guidance they're expecting. Then continue with content licensing, that is AI datasets deals for content monetization. This is important because this AI revenue, this content licensing revenue is way more higher margin than the traditional business. Then they're again focusing on the CUT examinations through Test Coach. All right. Important, they're focusing on working capital metrics and cash flows to continue. Major focus. And again, evaluating inorganic opportunities for enhancing the product portfolio. Inorganic opportunities, mergers, and acquisitions. So these were all the results for Eschon's quarter one fiscal year 2026.